There are 3 things anyone needs to start investing: the right account, the right asset allocation, and then some actual assets to buy. Let's break down each of these in more detail so you can understand what they mean and what each one might look like for your own unique situation. Alright, so first you need a specific type of account that allows you to invest your money. This is different from a normal savings account that just pays you interest. Investment accounts are a special type of bank account. You can transfer money in, just like with any other type of account, but instead of leaving that money there in cash, you can then use it to buy assets like shares or funds or bonds. The best option for most people is going to be a tax-advantaged account, which for us in the UK is called a stocks and shares ISA. This means you won't have to pay tax on any gains you make with your investments. Just a quick note, there are several different types of ISA, and there's also a limit on how much you can pay in each tax year. This annual limit, which is currently £20,000, applies across all your ISAs, not to each one. So for example, if you've already put £2,000 into a cash ISA, you can still open a stocks and shares ISA, but you could only put £18,000 into it this year. There are a lot of different providers who offer stocks and shares ISAs. Some of them might be familiar names and others might not, but I'll link a few reasonable choices below. Once you have an investment account, you need to plan your asset allocation. This might sound complicated, but I'll break it down in simple terms. Your asset allocation is simply how you choose to divide your investment money into different buckets or categories. It will be based on 3 main things: your investment goals, so what you want from your investment, your time horizon, so how long you want to invest for, and your personal tolerance for risk. For example, you might allocate 60% of your portfolio to stocks for growth, 30% to bonds for stability, and 10% to cash for safety and liquidity. This is called diversification, and the point of it is to spread all of your investments out and not put all of your eggs in one basket. So how do you know how to answer all these questions? I know I definitely struggled with this when I first started with investing. Let's look at each one in a bit more detail. Firstly, your investment goals. This is really a way of saying, do you want more growth or do you want stability and income from your investments? If you're a long way from retirement, you generally want to give your money the chance to grow as much as possible for the future, and you have time to ride out some ups and downs. So in this case, you would typically choose a more aggressive asset allocation with a large proportion of stocks, as this should maximize growth over the long term. On the other hand, a more conservative asset allocation is designed to avoid big ups and downs, but will also have lower returns overall and lower growth. This type of portfolio typically has a higher proportion of cash and fixed income securities such as bonds. Bonds provide stability and a steady stream of income, so are popular with people in or close to their retirement. So what about your time horizon? This is very closely related to your overall investment goals, so we've touched on it already, but the basic idea is, when you have several decades until retirement, you have a long time horizon, so you can get away with a more aggressive asset allocation. As you get closer to retirement, you might shift your asset allocation to be more conservative, so you'll have a more stable investment that can provide you with a nice income by the time you retire. There's a simple guideline called the Rule of 100, which suggests an investor's asset allocation between stocks and bonds should be approximately equal to 100 minus their age. So if you're 30 years old, the Rule of 100 suggests you should have 70% of your portfolio in stocks and 30% in bonds. By the time you're 60, you should have 40% in stocks and 60% in bonds. To account for longer life expectancies though, some people prefer to use a modified version of that rule by subtracting your age from 110 or 120 instead. This means allocating more of your assets to stocks and less to bonds, which can give you more growth over the long term and support a longer retirement. This is of course just a general guideline and not a hard and fast rule. The right asset allocation for you will depend on your individual circumstances, including your risk tolerance. We'll get to that next, but let's talk about risk for a second. The word risk is thrown around a lot in investing, and from conversations I've had, most people don't have a good sense of how to think about investment risk. The warnings of capital at risk make it sound like you could just lose everything at any second, and any money you invest could just disappear into thin air. But the reality isn't quite like that. Of course, there are situations where you can lose everything, like if you invest in only one company and that company goes out of business, but it's pretty easy to avoid scenarios like that. I find a more useful way to think about risk is to think in terms of fluctuation. So a high-risk portfolio doesn't usually mean that it has a high risk of going to zero at any second, but it is at risk of experiencing large swings, up or down, from year to year. This is where your personal risk tolerance comes in. In a year where there's a stock market crash and your portfolio drops by more than 20%, do you know what you would do? Let's look at two different possible responses. Meet Aisha and Charlie, two investors with a fairly aggressive asset allocation. Their portfolios have both taken a similar 30% hit. Aisha recognises that it's most likely a temporary drop and that the market should recover soon enough. She leaves her investment alone. But Charlie isn't so relaxed about it. In fact, he panics and sells everything. He doesn't want to see his money go down anymore, so he decides to cut his losses and get out of the stock market. In the case of a market drop, the best thing to do is usually to simply stay invested. If you can do that, you're probably safe to consider a more aggressive asset allocation. But if there's a chance you might be tempted to sell when the market falls, like Charlie, you'd be better off with a more stable allocation, so you wouldn't see such big fluctuations in the value of your investment overall. Another way to think about this is don't pick a really aggressive asset allocation if you think you might be tempted to sell your investments if the stock market crashes. So by now you should have a reasonable idea of what kind of asset allocation to go for. It's time to choose your actual assets. Stock market investing can be risky if you get this part wrong, but luckily there's a way we can minimize this risk through diversification. Remember how I was saying that if you only buy the stock of one company, that's risky? Well, that's why people typically invest in a lot more than just a single stock. A well-diversified portfolio doesn't just have a handful of stocks either. You want a wide range of assets spread out across different geographies, industry sectors, and company sizes. This helps you minimize the impact of any one company's poor performance on your overall portfolio. A diversified portfolio is also often multi-asset, meaning it includes not just stocks, but also bonds, cash, maybe property, and sometimes even other asset classes. While many people do pick individual stocks, it takes a lot of work to do this properly. Keeping up with news on each company, following earnings announcements, and tracking other financial metrics takes a lot of time and knowledge. And even if you do all of that, it's still often hard to use the information to predict what any of it is going to mean for a company's stock price. The stock market is unpredictable, and even professional investors don't always manage this very consistently. Thankfully, there's a much easier way to invest though. This method doesn't require you to know anything about individual stocks and works for anyone, even complete beginners. In fact, it works best when you just put your money in and forget about it for years. This is all possible thanks to something called an index fund. This is the easiest way for beginners to get a diversified investment portfolio. I'll explain index investing in more depth in this next video.